Welcome to Biztech's Inside Trading Show. Hi, I'm Brian Fernandez, and our guest today is Philip Waters. He's the head of Asia Pacific and Emerging Markets at OANDA. OANDA is a global leader in online multi-asset trading services, offering forex, indices, commodities, metals, and bonds to retail traders, as well as institutional clients worldwide. To give us insights into OANDA Corp and what they do in the Asia Pacific region, as well as some key trends to watch out for. Welcome to the show, Philip.
Thank you, Brian. Thank you for having me on.
Now, Phil, for a start, give us an overview of OANDA and what you do.
Of course, yeah. So OANDA is primarily a CFD trading business. So we offer trading services to clients across the world. We've got significant market share in the US, across Europe, and across different Asian countries as well. I mean, I'm based here in Singapore, and it's one of our bigger markets where we are one of the top 3 players here. But we've also got a big presence in Japan. We are a growing business in the Australia region, and we're penetrating the emerging markets quite well, particularly in the Asia region, but across other parts of the world as well. So it's a CFD trading business primarily. We do have other data services that we offer as well, but first and foremost, and where I spend most of my time in this business is driving growth in the region for that CFD trading business specifically, which is a retail, it's focused on a retail audience that we're typically going after. More than the institutional audience, it's much more retail for OANDA.
So, Phil, what does the retail trading landscape look like in Asia? That's your remit today. What does that look like?
Yeah, it's a good question. And it's really exciting at the moment. I think it's quite easy to generalize and think of Asia as one big market, but it's just not what Asia is. Asia is not monolithic. It consists of diverse countries with unique financial ecosystems. And so the answer to that question is a pretty long one, because you'd have to go country by country. And it's also the reason why it's a really exciting region, because there's just so much happening in all different directions. We could probably talk this whole segment just about China. But then there's also so much going on in other parts of Asia. Singapore is a small place, but is a heavyweight in context of its size. But the reason because of how unique each of these countries are, what it means for a business like OANDA is that you have to really localize your approach to the different countries. You can't take a one-size-fits-all approach and assume it's going to be the answer to growth in each of these different high potential Asian markets. We tried to do that. We prioritize a number of different markets in this side of the world, and we take a tailored approach to several of those countries to try and cater to the different needs that exist, because they are different, for various reasons. They're different in each of these countries. So it's a very loaded question. It's a super exciting region. There is always, from an Asia perspective, there's always interest in the US markets. So really, a lot of the excitement is actually coupled with what's going on in that side of the world, as eyes are on the West. But then domestically, there's so much happening as well, and China plays a massive part in that. You've got lots of dynamism coming from many of the Southeast Asian markets as well. Singapore obviously being the most well-established in that mix of countries, but then you've got some countries like Malaysia and Thailand in particular who are growing at a decent pace this year, above the global index benchmark, so above above pace. So overall, yeah, that's a quick summary, I guess, on the things happening in this side of the world. Very exciting to be in Singapore and trying to drive the growth on this side of the business.
Now, how is the landscape differ from more mature markets like the US? Is somewhere like Singapore perhaps mirroring a lot of the more developed Singapore and Australia, for example, whereas some of the other less developed markets are a little bit different?
Yes and no. I mean, I think that in today's world, there are more commonalities and differences, even between the more established countries like Singapore and so between Singapore and the US, I think that there are lots of similarities, but even the emerging markets, which have lots of differences in terms of the financial ecosystems, and the US and the more mature markets. So there are differences for sure, and many of these countries have strong ties to China, they have strong ties to the US, and so a lot of the growth trajectory very much hinges on what's going on in those different countries, but they also now domestically have a lot of strength, and many of them are able to, as I said earlier, particularly Malaysia, Thailand, they're able to outperform some of those more established markets. And I guess that in some ways that's expected because, in these growth markets like Malaysia, like Thailand, and some of the frontier markets, even like Vietnam, the growth potential is much higher. But as I say, for so long, they're very much have been dependent on the growth and the advancement in these other economies. That seems to be, I guess, just over time, naturally pulling away a bit more and more, so they can be a bit more self-sufficient in their growth in the region. From a trader perspective, if I think of it from a retail trader perspective, again, I think more commonalities than differences these days. Traders have high expectations, and rightly so. So they want to be partnered with the best broker that can offer them reliable, trustworthy technology, great content to keep them informed, great risk management tools to make sure that they are controlling the emotions that always come with trading and are really hard. It's always, it's what everyone says, is you've got to control those emotions and apply risk management practices to be really successful in trading. It's so hard to do in practice. And I think a big part of that ability to be able to do that in practice comes down to choosing the right provider that can give you all the tools, the information, the data, the content to do that well and promote it. Many brokers in this space, their business models are not set up and aligned with the interest of the user, the client. And that's, I think, something that can be quite easily missed from a user's perspective. So it's just, in my opinion, super important and consistent across the world. So this is one of these commonalities that exist, that you're choosing a provider that quite clearly has set themselves up to make sure that you're a successful trader, a smarter trader. And it's a slogan that we live by. It's all around smarter trading for clients.
Now, Phil, I want to now take a view around the macro position and how it's impacting your traders and your customers and so forth. Now, the first thing that we need to look at is think political risk, an election risk. All of a sudden, we've got a US election this year. We've just had some debates which throw a spanner in the works in terms of the US election and how that's going ahead. We've just had this other spanner in the works around the French election. How do you see Singapore and the rest of ASEAN performing in the second half of the year?
Yeah, the US election debate, I thought in particular, was very interesting. Earlier than normal, so that was first of all quite interesting. Normally, these debates are held a bit later on, nearer the election date itself. So there's a lot of runway now to get people thinking and speculating about which way this is going to go. The steam rain the steam train rather is on track, I guess, if you like. I mean, that is going to be a really interesting run-in. The answer to that question is, I've mentioned this before, but in particular in Singapore and the Southeast Asian territories, there is very high interest in what's going on in that US market, and all eyes will be on this US presidential election. We've seen over the last 2 years in particular significant growth in the amount of the trading volume we see that is going into particularly US indices. So there is huge interest just by virtue of what we're seeing in terms of client activity. So I think the impact of the US election itself will be significant, and people will be paying very close attention to that. But in the build-up, I think that where we would hope to succeed in that regard is that we want to provide our clients in Singapore, in Southeast Asia, with as much content, information in the build-up to the US elections and, to your point earlier, the French elections as possible, but particularly the US elections, just because we know that's a real hot area for our clients in Singapore. But I mean, if I were to just talk about some of the indexes across the Asia territories as well, there's been divergences in performances. So if you use the MSCI Emerging Markets Asia Index as a benchmark, in 2024 year to date, the outperformance so far have been Taiwan, Malaysia, and India. So you've got the Taiwan TAIEX, the Malaysia KLCI, and the India Nifty. So they are 23%, 11%, and 8% up, respectively. So South Korea is on par with that Asia benchmark, 2.9%. And then the China index, CSI 300, is underperformed. So there's there's real divergence there. The Southeast Asian markets are performing more strongly than China, which is, I think, somewhat expected with some of the challenges in China. But the catalysts for those outperformers are really driven by those US initiatives, which is so manufacturing supply chains, friendshoring amid the ongoing US-China high-tech war. So that's benefited Taiwan, India, and Malaysia. South Korea's stock markets failed to really ignite that friendshoring vibes, and that's due to the weaker internal corporate governance of South Korean companies, which has pushed down their valuations. And then the other point to mention really about the catalyst there is around the AI-driven themed play. So one of the biggest market cap stocks for Taiwan in the TAIEX is the TMSC, and what they're doing is, well, it's the production hub for NVIDIA's high-end GPU chips. So it's just an interesting point to make just about those interconnections that exist, and obviously NVIDIA is headline news at the moment because it's become the most valuable company in the world and surpassed some of those other prominent names like Apple and Google. But there are these beneficiaries in other markets like Taiwan, and it's because of that production line that exists for NVIDIA in that case. And it's just a really interesting point how that AI theme in the US, which is a very prominent news point at the moment, extends way beyond the US and into the Taiwanese market, and the Taiwanese market as a result is benefiting from that.
And are your retail traders then trying to benefit from that by altering their trading investment strategies?
Yes and no, and this is something I think is the difference between being really a successful trader again and you can still be successful, I think, without doing this, but I think it can limit your potential, which is the need to really diversify your investments, because the US, rightly so, is a very interesting market to pay attention to. There is a lot happening. It's going to be extremely exciting in the build-up to the US elections. There's the US-China trade war disputes that are going to be ongoing. But there's opportunities in all these other markets, and there's growth potential in all these other markets that is actually, so far this year, and as I mentioned earlier, in many cases, outperforming some of the more global indexes. So the opportunity to diversify, which both represents other growth opportunities and an opportunity to diversify on risk, is there. And I think it's something that it's a message that we try to land with our clients all the time. It's sometimes difficult to resonate with because I don't think some of those other markets get as much attention, but it's an important thing to always keep in the back of your mind is even if the opportunity for growth might not look as exciting, the potential to diversify your risk alone, just by spreading that across different markets, should always be a motivation when trading. And obviously there's other ways in which you can risk manage better in order to be a more successful and a smarter trader. That is just one way to do it, is to diversify your investment into different regions.
Now, Phil, it's been a great conversation. Thank you very much for your valuable insights. But before we leave, any final thoughts you'd like to leave the audience with?
Yeah, I think I'm going to reiterate something I've already talked about and just talk maybe a little bit more about it, which is ultimately the need to apply risk management practices in order to be a successful trader. It is super easy to get involved into trading, and it's super easy to get it wrong, unfortunately. They are the facts. And that's primarily because trading isn't easy. And there are lots of different reasons why people trade. When people do decide to trade, there are lots of different ways to do it. There are different styles. There is one thing that should be consistent regardless of all of those variables, and that is make sure that you prepare well, you keep yourself informed, and you learn, you educate yourself on the markets, you keep up to date on what's relevant at the time before you're placing your trades, you devise a trading plan, and then you apply risk management tools. And at its sort of minimum, that is using stop losses and take profits on your trades. So just using those alone will ensure that you're taking a much more measured approach to the way you trade, will significantly increase your chances of becoming a successful trader. And it's not to say that it's not a guaranteed blueprint for being a successful trader. That's not the point, but it's just about increasing your chances of becoming a successful trader. Really easy to talk about it in theory, really difficult in my experience to put that into practice. And that's just something that people have to be really aware of. And where it tends to, I think, go wrong for people is they can be on form 95% of the time. They can stick to that plan 95% of the time. And when things go bad, that's when that plan sometimes can go out the window. And it's about sticking to that plan regardless and not letting those emotions take over, which are, in and of itself, those risk management tools should help control the emotion that comes with trading without them. So that would be my message just to end on is, obviously, make sure that trading is for you and make sure that you're aware of all the risks involved that come with trading. There are plenty of great reasons to do it, lots of opportunities in the markets across the globe, but just make sure you're doing it in a really sensible way. And that, as a very basic starting point, is ensuring that you're always applying risk management techniques and tools as you're executing on your trades.
Phil, thank you very much for taking your time to be on the show. It's been a pleasure.
Very welcome. Thanks for having me again.
Now, we've been speaking to Philip Waters. He's the head of Asia Pacific and Emerging Markets for OANDA. I'm Brian Fernandez, and you've been watching and listening to Biztech's Inside Trading Show. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.